Nowadays, there are a lot of traders who are speaking about liquidity in the form of market structure. They show all of these visual schematics and they claim these to be key liquidity pools. During this lecture, however, I'm going to show to you how all of these schematics mean absolutely nothing without the element of time. During this lecture, I'll be showing to you how time plays a crucial role when it comes to determining key liquidity pools. Once you're able to understand the importance of time when it comes to determining liquidity pools, you'll be able to anticipate from when and where key market reversals are likely going to take place. This is how me and hundreds of my students are able to achieve massive success within the markets. With that being said, let us dive into this video. Liquidity explained from an algorithmic perspective. As mentioned throughout the intro, we are going to be looking at liquidity through a fully mechanical lens, meaning we're going to be paying attention to the only two objective variables there are, and those are time and price. So when it comes to looking at liquidity from an algorithmic perspective, it's important to note the following. In order for there to be a buyer, there has to be a seller. In order for there to be a seller, there also has to be a buyer. This counterparty gets engineered and induced by high-frequency trading algorithms. They orchestrate price swings. So yes, I'm saying this out here. Every single price swing is absolutely engineered and mapped out. That right there is the result of these markets being rigged. And this is something which I've been sharing more and more of over the course of these past couple of lectures. And I promise that by the end of this lecture, you will have gotten a great insight when it comes to time and its importance on the markets. So when it comes to this underlying belief system, where we say that every single market swing is programmed and it's engineered, it's important to note that price on the y-axis gets manipulated. Meaning what smart money can do is they can literally cause price swings to occur. However, time on the x-axis stays the same. Always. The clock will always keep on ticking, and therefore they cannot manipulate time, but they can manipulate price. And that is something which I will share with you during this lecture. So when it comes to the engineering of liquidity and the inducing of traders, we are going to be paying attention to the following two schematics. And these two schematics are crucial to understand. When it comes to engineering of liquidity, what this looks like is the following. What you can see is that the market on the left expands towards the downside and it retraces higher. The moment that this retracement higher occurs, sell-side liquidity is being engineered below this low. And the reason why sell-side liquidity is being engineered below that low is because retail-minded traders will look at that low formation and they will think to themselves, hey, a strong support level has been reached. The market should turn around from now. So what they do is they press market buy and they place a stop loss below this low. This is how sell-side liquidity gets engineered. The market will then seek to expand towards the downside. If we pay attention to the bullish example then, what we can see is that the market expands towards the upside and we see this high form. A retracement lower occurs, and as that retracement lower is taking place, what a lot of retail-minded traders are thinking to themselves is that they look at this high formation as, oh, we reached a strong resistance level, the market is now going to roll over. What do? Is they press market short and they place their stop losses above this high. That is why buy-side liquidity is being engineered. So what IPDA will seek to do is that it will seek to expand towards that engineered buy-side liquidity pool next. When it comes to the engineering of liquidity, this can be looked at once you recognize the direction of the underlying market that you're making your analysis on. Once you know where price is drawn towards and you know the higher time frame draw liquidity, you are going to see the market stop in advance of that draw liquidity. And when the market stops in advance of that draw liquidity, that is the engineering of liquidity taking place. And this is very important when it comes to recognizing sell programs and buy programs. When it comes to inducing traders then, what it looks like is the following. What you can see is that when we pay attention to the schematic on the left, we can see that the market expands towards the downside, a retracement higher occurs, and we then see one more expansion towards the downside occur. We take out sell-side liquidity resting below this low. However, through that drop below that low, what's also being caused is the following. A lot of traders will look at that as the following. They are going to think to themselves, hey, the market is now breaking towards the downside. We should go market short. So what they will do is they will short the breakout. And because they will short the breakout, that's a lot of sellers which are stepping into the marketplace, which smart money can utilize to fulfill their long orders. So where you will see this inducing taking place is when the market is near your point of interest. It's near that key level where you're anticipating that reverse to take place from. What I'm always looking for is I'm looking for liquidity to be engineered in advance of that key level. And the reason being is because as I see the market stop in advance of that key level right here, the key level being this red line for info, when I see that stop in advance of that key level and I see this retracement higher, and there's this one more push lower, which is usually a very quick drop lower, I know that the majority of traders who were long prior are going to get stopped out because they have their stop losses below this low. And next to that, I know that a lot of sellers are going to be stepping into the marketplace. However, as the market is expanding lower and we reach that key level, that is where I'm going to be looking for the signs of a reversal taking place, of that smart money reversal occurring. So there are two elements when it comes to the engineering of liquidity, and secondly, to the inducing of traders, because of the following. What you need to understand is that what I'm outlining to you now is a price schematic. And I understand that you might be like, oh, is that all that you're going to discuss during this lecture? Absolutely not. However, you need to understand these two very simple variations, where it's either the engineering of liquidity or the inducing of traders. And once you understand what this physically looks like, and you begin paying attention to everything which I'm going to be outlining to you later during this lecture, with regards to time, you're going to be looking at these marks and you're going to be thinking to yourself, damn, how has this been hidden so well in plain sight? Because as this drop lower is taking place and we reach that key level, the signs will become present of a reversal taking place. As those signs become present of a reversal taking place, what's happening is that the market is changing from sell program to buy program. And as that change from sell program to buy program is taking place, only then can you be using those discount arrays, those bullish breakers, those bullish fair value gaps for entry opportunities, not any time prior. So the issue which you have been facing all this time, where you were purely trading based on those PD arrays, is not so much that you don't understand the PD arrays, it's more so that you don't understand when and when not to use them. I'm literally outlining to you now when to start paying attention to PD arrays. And it's only once these elements are in play. So once we pay attention to the bearish example then, what you can see is that the market expands towards the upside, this high forms, and notice that this high forms in advance of this key level on the upside. This key level can be, for example, a bigger time cycle high, it can be a higher time frame array, etc. There are way more elements when it comes to determining key levels. However, for this lecture, I'm simply going to be speaking about liquidity. So as this high is forming right here, and we see that retracement lower taking place, from that moment in time, I know that liquidity is being engineered above this high. Why? Because retail mind traders will look to go short as the market is dropping right here. What will happen then is that as this final push higher takes place and the market trades above this high, a lot of traders will be trying to trade the market on the breakout. They will go long as the market is trading above this high. However, that right there is exactly what smart money wants, and the reason why is because as price is going to reach that key level and we're going to see those big green candles with a lot of speed and velocity, they are going to short against that. They're going to be selling as the market is going higher. And that right there is by far the most important understanding to have, where you begin to realize that smart money sells as the market is going higher and they buy as the market is going lower once their reference points get met. So as the market is repricing higher as it is right here and we reach that key level, retail will be looking to buy while smart money will be looking to sell. So what happens is that buyers liquidity is going to get taken out above this high. And secondly, new buyers will be stepping into the marketplace that will be trading it on a breakout. The moment that this smart money reversal takes place right there, from that moment in time, we can be looking at premium raise for potential entry opportunities. So now that we have defined both the engineering of liquidity as the inducing of traders, we can begin paying attention to time. But these are the two different price concepts which you need to understand, and notice that they are connected, because when you pay attention to these schematics, what you will see is that the sell program right here, where sales liquidity was being engineered, actually turns into the buy program right here as that inducing of the traders is taking place. The opposing, of course, occurs when you see buy-side liquidity being engineered and the inducement of buyers takes place. So when the market reaches that key level and we see the signs of that smart money reversal, from there onwards we can anticipate that sell program to originate. So notice that they are connected in that way. And if you do not understand what I've just outlined to you, and I'm going too quick for you, I highly suggest you to play back this video just a few minutes and rewatch it, because I promise, if you re-listen closely to what I've just outlined to you and you start to understand the logic behind why this is taking place, you will never be able to look at the marks from the same perspective again. And you'll be able to realize, hey, this is where manipulation is taking place. And simply by being able to recognize where manipulation is taking place, you're already going to have way more clarity when it comes to anticipating price swings. Liquidity does not get spotted by paying attention only to market structure. That is what I outlined throughout the beginning of this video as well. True liquidity gets recognized through time. Meaning, you probably already know that buy-side liquidity is resting above old highs and sell-side liquidity is resting below old lows. However, you've never been able to figure out what liquidity pools actually matter. The reason why it is the case is because you have been too fixated on those visual schematics of market structure, of price patterns, etc. The answer that you're looking for is down here. And that is on the time axis. And during this lecture, I'm going to be giving you all the insights which you need in order to be able to recognize time and its importance on price. So when it comes to my belief of the marketplace, it's important to note that it's time then price. Meaning time comes before I even pay attention to price. The reason why liquidity gets recognized through time is because smart money can't manipulate time. Price can be manipulated, but the clock keeps on ticking. Tick, tock, tick, tock. And therefore, time plays a huge role when it comes to recognizing these high-frequency trading algorithms, their footprints. So to not pay attention to time is literally holding yourself back significantly. PXH and PXL is the truth behind liquidity. And what this means is that the previous cycle high and the previous cycle low are the only two reference points which you need to be paying attention to from a liquidity perspective. Because what my time cycles theory tells you to do is the following. It tells you to pay attention to every single previous cycle high and previous cycle low. And by monitoring the reaction to those levels, you're able to gauge the order flow in an objective manner. Because there are only two variations that can occur. We're either going to see a purge and revert, where a new time cycle opens up, drops lower, taking out the previous cycle low. We see the signs of a smart money reversal taking place below that low, and we then see the market revert towards the previous cycle high. Or we see a bearish example where the market opens up, takes out the previous cycle high, we revert towards the previous cycle low. Or we see continuation taking place, where we see the market open up for a new time cycle, run above the previous cycle high, retrace into that, find support there, and then begin expanding towards the upside. Or for the bearish example, of course, where we see a new time cycle open up, drop lower, taking out the previous cycle low. We see a retracement higher taking place into that previous cycle low, and continuation lower is going to occur. These are the only variations that are possible once you start paying attention to PXH and PXL. And during this lecture, you will learn exactly how to do so. I understand that for the majority of you, time cycles are a pretty hard concept to grasp so far. However, that's a result of you not having looked at it from this very simple approach. I am going to be explaining time to you from the most simplistic manner possible. However, that's a result of me having simplified very advanced knowledge. And once you start looking for these signatures in the markets, yeah, you're going to be like, damn. So when it comes to time cycles paired with trading styles, these are the combinations which I suggest. For position trading, pay attention to yearly cycles and quarterly cycles. When it comes to swing trading, pay attention to monthly cycles, weekly cycles, daily cycles. When it comes to day trading, pay attention to weekly cycles, daily cycles, and 90-minute cycles. Don't worry, I'm going to be walking you through each one of these individual cycles. I'm going to be giving you the exact times which you can start paying attention to. However, Based upon this schematic right here, you're able to define what time cycles you should be paying attention to based upon your trading approach. If you are a day trader, then we pay attention to weekly cycles, daily cycles, and 90-minute cycles. If you, however, are position trading or an investor, we pay attention to yearly cycles and quarterly cycles. The logic, however, that I'm explaining during this lecture remains exactly the same, and that's the result of everything being fractal, meaning the same logic applies on a 1-minute time frame as it does on a daily time frame. And you tell me, how is it possible that that is the case if these markets were random? If these markets were simply going up and down based upon supply and demand? You try and explain that to me. And let me tell you something. You can't explain it. And simply by understanding the fractality of price, you're able to realize, hey, these signatures occur again and again and again. But here comes the most beautiful part. It's not only price that is fractal. Time is also fractal. And once you start to see that, man oh man, a whole new world will open up for you. So when it comes to yearly cycles looks like the following. The new year begins at January 1st and ends at December 31st. That is one yearly cycle. So when a new year opens up, you immediately have two reference points. And those are your previous yearly high, previous yearly low. Next to that, we pay attention to quarterly cycles. The first quarterly cycle begins at the start of January and ends at the end of March. The second quarterly cycle begins in the start of April and ends in the end of June. The third quarterly cycle begins in the start of July and ends in September. The fourth quarterly cycle begins in October and ends in December. So what's important to note is that when it comes to these time cycles, the moment that any new time cycle opens up, whether it be a new quarter or whether it be a new year, you immediately do one thing. And this is how I want you to start looking at the markets. You are going to annotate where is the previous cycle high and where is the previous cycle low. And that cycle is again relative to the analysis which you're making. Whether you're making a long-term analysis, whether you're making a short-term analysis. And therefore choose your time cycles accordingly based upon what I've just outlined within that schematic of what time cycles to use for each individual trading style. When it comes to monthly cycles then, the monthly cycles look like the following, where every single new month, a new month will open up. And from that moment that that new month opens up, we pay attention to the previous month's high and the previous month's low. We pay attention to this monthly cycle until the end of this month. And as that end of the month is approaching, we know, okay, during this month a high and low will have formed, and throughout the next month we're going to be paying attention to those levels again. When it comes to weekly cycles then, the weekly cycle begins from Monday and ends until Friday. So when a new week opens up, the first thing you do is you annotate where's my previous week's high, where's my previous week's low. When it comes to daily cycles then, for the intraday traders that are watching this video, I look at every single day from midnight to midnight. And it's important to note that the times which I will be explaining to you right here are in New York time. So if you are following along with my teachings, always put your TradingView charts to New York time. And the reason why is because IBDA runs on New York time. Midnight to midnight is one day. There's one exception, however, and that's the first day of each week when we have the Sunday Open taking place at 6 p.m. When the Sunday Open takes place at 6 p.m., we pay attention to Monday's delivery from 6 p.m. to Tuesday midnight. When it comes to the Asia session then, the Asia session is from 6 p.m. to 2:30 a.m. New York time. The London session is from 2:30 a.m. to 7 a.m. The New York AM session is from 7 a.m. to 11:30 a.m. And the New York PM session is from 11:30 a.m. to 4 p.m. Now, when it comes to these different sessions, it's important to note that every single day and every single week, these times are the same. And that's the most important part to understand when it comes to these time cycles. They do not change. They're fixed. They're literally the same every single week, every single month, every single quarter, every single year. And that is why if you go back a long time into the past and you start investigating the charts, you will see exactly the same signatures taking place, even before markets were being traded electronically. How is that possible? Because they were literally manually controlling every single market fluctuation. And what were they using? They were using specific windows in time to do specific things in price. When it comes to 90-minute cycles then, each session has 90-minute cycles. However, for the AC session, I do not pay attention to 90-minute cycles. You could, however, in my opinion, the majority of volatility and real opportunities present themselves throughout the London, New York AM and New York PM session. And that is also where I suggest your focus to be on. When it comes to 90-minute cycles, there are 3 90-minute cycles in each of the sessions which we're going to be paying attention to. First of all, we have the London session, which begins at 2:30 AM. The first 90-minute cycle is from 2:30 AM to 4 AM. This is London 1. The second 90-minute cycle is from 4 AM to 5:30 AM. This is London 2. The third 90-minute cycle is from 5:30 AM to 7 AM. This is London 3. When it comes to each one of these specific cycles, there are key characteristics which we're going to be paying attention to, which are universal for each one of the sessions, and I will share with you soon what to look for. When it comes to the New York AM session, it begins at 7 AM and the first 90-minute cycle lasts until 8:30 AM. This is AM1. The second 90-minute cycle is from 8:30 AM to 10 AM. This is AM2. And the third 90-minute cycle is from 10 AM to 11:30 AM. When it comes to the afternoon session then, there are also 3 90-minute cycles which you can be paying attention to. The first cycle is from 11:30 AM to 1 PM. This is referred to as PM1 or the lunch cycle. The second 90-minute cycle begins at 1 PM and lasts until 2:30 PM. This is PM2. And the third 90-minute cycle begins at 2:30 PM and it lasts until 4 PM. This is PM3. Now, when it comes to each one of these 90-minute cycles, it's important to note that their foundation has a key characteristic. And that right there is the following. Since there are 3 90-minute cycles in both the London as New York AM and New York PM session, we can be looking at each one of these sessions from an AMD perspective. In every single regular day, the first 90-minute cycle of each session accumulates. The second 90-minute cycle manipulates. And the third 90-minute cycle distributes. This right here, however, does not mean that every single day the lower high of a session is going to form throughout AM2 or throughout PM2. And the reason why is due to the following. The time cycles shift, meaning their function shifts. Their underlying timings remain the same. However, the function of each specific time cycle shifts. And therefore, what you need to start paying attention to is when that manipulation is taking place. Because once you recognize that manipulation taking place, you can anticipate what time cycles are also likely going to distribute. And that is what your focus has to be on. So if you have watched my lecture on time, that you can see right here. In that lecture, I share exactly how you can recognize manipulation taking place. Because it has to do with you being able to recognize swing highs or swing lows forming. And once you recognize swing highs and swing lows forming, you're able to anticipate when that distribution is going to occur. So therefore, I highly suggest you to check out this lecture if you haven't yet. Because in there, I share everything you need to know when it comes to anticipating when and where volatility injections are going to occur. Let us now pay attention to a variety of chart examples across different time frames. First of all, we're going to be paying attention to this weekly chart of the Nasdaq, where you can see that I've outlined the 2024 high and the 2024 low. The reason why I've done so is because we're now at the time of this recording in the year 2025. When you pay attention to what happened from the yearly open, you can see that the market initially grinded towards the upside throughout the first quarter. Notice that we saw the market come very close to the 2024 high, but notice that the market stopped right in advance fit right here. This is the engineering of liquidity which was taking place. Notice that we then expanded towards the downside throughout the latter part of the first quarter. We then saw the second quarter open up, and what the second quarter did was immediately expand towards the downside. Notice that we took out the 2024 low, and here's something of great importance occurred, and that is the following. Notice that we took out the 2024 low, but did not utilize this resistance price. Instead, we saw the market reject that low and saw the signs of a smart money reversal taking place. From that moment in time, you must immediately think to yourself, hey, this could be a potential purge and refer taking place. And if you blend this with all of the things that were going on in the world, you can see how there was a lot of fear being induced into the world. And in that fear, that is exactly where smart money was buying. So what you can see is that we saw a rejection taking place of that 2024 low. And we then saw the market revert towards what? Towards the 2024 high. Purge the previous year's low, revert towards the previous year's high. Yearly purge and revert done. Notice that this is all a result of liquidity being engineered up here at these relatively equal highs. When we pay attention to a daily time frame then of Nasdaq throughout this same run, what you can see is the following. What you can see is that we also had the Q1 low, which was engineered, the first quarter low, engineered in advance of the 2024 low. So when that second quarter opened up and immediately expanded towards the downside, my eye was drawn towards monitoring how the market would react off that first quarter's low. So I was not only paying attention to the 2024 low to confirm the smart money reversal, I was also paying attention to the first quarter's low, the previous quarter's low. And once I saw the market reject that first quarter's low, at first it was not confirmed yet that this would be a potential swing low formation. However, when we saw the market expand above that first quarter's low, the full candle where you can see that I've outlined the high and the low of this candle, from that moment in time, I knew that we were in a buy program, and I knew that we would likely begin drawing towards buy liquidity resting above the first quarter's high. So do you see how I'm blending both the yearly cycle as the quarterly cycle to come to the conclusion of what the underlying order flow is? So even as a day trader, this is very important to do, and the reason being is because this is how you define your higher time frame institutional order flow. Without paying attention to these higher time frames, it's very easy to get lost on the lower time frames. But once you start paying attention to, first of all, your higher time frame analysis, and only secondly, your lower time frame analysis, you're going to be trading in sync with the higher time frames. And that right there is where you can anticipate low resistance liquidity runs to occur as well. So the market repriced towards the upside, and notice that we repriced above this CB right here. This CB got utilized as support and price, and from that moment in time, boom, we're in a complete buy program. No doubt about it at all. When we pay attention to an RE chart of Nasdaq then, we're going to be paying attention to the weekly cycle. Notice that throughout the previous week, what we saw taking place was that the market was slowly grinding towards the downside. I've outlined the previous week's high and the previous week's low. The new week opens up, and what the new week open immediately does is it opens low, taking out the previous week's low, and notice that we come above it right away. What it signals to us is that we just took out key sell-side liquidity resting below the previous week's low, and we see the market get back above that previous week's low. So from that moment in time, we can be monitoring for this counter raise to get created to signal to us, hey, price is in fact going to draw towards the previous week's high, towards engineered buy-side liquidity. Why? Because we have established that both the yearly as the quarterly cycle are bullish, the monthly cycles are signaling bullish, and now the weekly cycle is also telling to us, hey, we're likely going to expand towards the upside. So what you can see is that I'm blending all these different time cycles, and all I'm looking for is purge and revert towards the upside again and again and again. When we then zoom into the lower time frames and we pay attention to a daily cycle, what you can see is that I've outlined the Asia high and the London high right here. Notice that when London opened up, we saw the market run towards the upside and stop right in advance of the Asia high. Hey, think back to what I outlined to that weekly time frame of Nasdaq, where we saw the Q1 high forming close proximity to the 2024 high. Here you can see that the London high forms very close to the Asia high. So that's engineered buy-side liquidity because there are relatively equal highs which are time-based, which we're likely going to draw towards throughout a new time cycle. We see the remainder of the London session expand towards the downside. The morning session opens up and initially has this run higher. We see the market form the high of the first 90-minute cycle, and we see it expand towards the downside. We take out the London low, retracement higher occurs, and we see the market expand towards the downside again, creating the low of the first 90-minute cycle of the morning session. We then see AM2 open up, and we see it open low, manipulating towards the downside, and we see the market take out this morning session's low. Notice that we see the market then revert and draw towards the upside with a lot of speed and velocity. So from that moment in time, we can establish, hey, we just took out the previous 90-minute cycle low. It failed to function as resistance on price, and we see instead displacement taking place above it. So from that moment in time, I'm immediately anticipating, hey, we just formed a potential low of AM, and we are now likely going to expand towards the upside. We see the market retrace and expand towards the AM1 high. We expand above it, retrace into that candle's range, and we see the market expand higher, drawing towards those previous sessions high of the London high and the Asia high. So what you can see is that I'm paying attention to the reactions to these very specific time-based highs and lows to gauge the order flow. And by recognizing manipulation, as you can see, which took place from 8:30 AM when we opened low, taking out that previous 90-minute cycle low, setting up the creation of a new morning session low, from that moment in time, we can be looking for the signs of discount rates to be created. And what do you see? You see, for example, this bullish fair value gap be established right here. We see, for example, this high getting displaced through, which formed inside of this CB. So this CB should function as support and price. So what you can see is that by paying attention to these purge and reverts, you're able to anticipate from when and where you can start beginning to look at PD arrays to gauge the order flow. PD arrays always come after we see a purge and revert taking place, not anytime sooner. When we pay attention then to low resistance versus high resistance liquidity runs, these are the different types of ways that price expands. Price either runs towards a liquidity or it walks there. Your job is recognizing when it will sprint. And the reason being is because you never want to be trading a market move where the market is just slowly grinding towards your objective. It's first of all very draining to do so. And secondly, it's also not worth it to be spending so much mental capital in front of the charts. Instead, your focus should be on recognizing low resistance liquidity runs. Low resistance liquidity runs are the most fun moves to trade, and the reason being is because price immediately will expand towards your objective. I will share with you specific insights when it comes to recognizing when low resistance is likely going to take place. When it comes to recognizing when a low resistance liquidity run is likely going to occur, your main focus is on paying attention to how the left side of the curve delivered. If the left side of the curve was very quick, with its drop towards the downside, what that sets up is a high resistance liquidity run on the right side of the curve. Meaning, if you see a left side of the curve where the market immediately just dumps towards the downside, and we then see the smart money reversal eventually taking place, you still anticipate the buy program. However, that buy program is likely going to get followed with a lot of back and forth going, a lot of consolidations and then expansions, instead of it simply just expanding, retracing, expanding. So pay attention to the left side of the curve to anticipate how the right side of the curve is going to deliver. And it's the same for the bearish framework, where I can see that the left side of the curve sets up the right side of the curve. Meaning, if the buy side of the curve within a market maker sell model is super aggressive and it's very quick and sudden, anticipate that the right side of the curve within that market maker sell model is likely going to be rather messy, and there's likely going to be a lot of consolidation before the market in fact reaches your objective. With that being said, I want you to think about everything which I've discussed during this lecture. And I understand that you might have come to the end of this lecture and you might be thinking to yourself, that was a lot. It was, indeed. I discussed a lot during this lecture. However, if you are right now thinking about everything which I outlined to you, and you're beginning to realize the importance of time and liquidity pools that are time-based, you're already on the right path. So if you would simply just show up to the charts and begin paying attention to these very fixed start and ending time windows, pay attention to the highs and lows that form throughout these windows of time, you're already going to objectify your whole trading approach significantly. Because this is something that no one else out there that's trading based upon smart money concepts is doing. All that they look for is they look for very specific frameworks. They look for these price patterns. They look for these schematics, so to say, to determine their liquidity pools. Those schematics, however, have absolutely nothing to do with what's going on behind the scenes. All that smart money is doing is referring to one thing, and that is time-based liquidity. And once you recognize time-based liquidity being taken out in the form of manipulation, and you see the signs of reversal occurring, from that moment in time, you know that we're likely going to refer towards the opposing side of liquidity. Now, one thing which I would like to share with you is the following. If you've come to the end of this lecture and you have thought about everything which I outlined during this lecture, you might think to yourself, okay, I'm now there. Now I'm ready to trade. You're not. And the reason being is because you need to go into the charts for yourself and see whether or not there's any validity behind the things which I'm sharing with you. Once you are going to dive into your own charts and you're going to be paying attention to these very specific algorithmic signatures which I've taught to you publicly throughout this lecture, you are going to be seeing them repeat and repeat and repeat. And that right there is going to be one of the most fulfilling experiences within your journey. So once you start to see this, be sure to journal the feelings which you're going to experience. Next step, I want you to keep in mind that this is just the beginning of your journey. There's way more when it comes to how these high frequency trading algorithms operate and how they're coded to deliver price. However, I hope that this lecture has given you a good insight when it comes to how to use time when it comes to recognizing key liquidity pools. If you would like to learn more about blending time and price, and by paying attention to these very specific sequences in time and price, you can go below to the Matrix Unlocked and you can schedule a free consultation call where you will be given more insights on these topics. I want to thank you for watching this lecture all the way to the end. I hope that you found it insightful. If you did, please let me know in the comments, and I look forward to speaking to you in the next one again. Be safe.